Tax Season Recap, Top 10 Stumbling Blocks for Small Business Owners, was a live webinar that was originally produced on Thursday, June 1st, 2017. The presenters for this presentation were David Blaine, Lindsay Young, and Charles Eisenhart, all with McConley and Asbury. Enjoy this webinar recap and visit us online at www.macpas.com for more information about our future events.
Tyler, thank you very much. My name is David Blaine. I'm a partner with McConley and Asbury in our small business, or what we like to call our entrepreneurial services group practice. With me again is Charlie Hustle Eisenhart and Lindsay Young. And what today we're going to do is we're going to spend a little bit of time talking about a recap of the tax season and some areas that we identified through our tax return preparation and financial statement preparation for our clients that for small business owners they should probably be paying a little bit more attention to, or a little bit closer attention to, as they go through 2017 into the end of the 2017 year. We just thought we'd share those findings with everybody and try to address those findings with ways and solutions on how to better identify what those issues are and having that information available. So Tyler, if you can go to the next slide there. So we're going to do this in a countdown type of presentation. It's almost like NFL films, like the top 10 best players in the country. But we're going to go with the top 10. We're going to start with number 10. Number 10, stumbling blocks. Mileage. So Charlie, why don't you talk a little bit about on the tax side, what were some of the issues that you identified when we were looking at mileage for shareholders and for some of our small business clients?
Thanks, Dave. When we talk about mileage, what we're really talking about is the cost of a car and putting that cost into your business. And so the IRS really has two ways that you can keep track of mileage. The first one is just keeping track of mileage. And so the IRS has set rates every year. It was 57.5 cents in 2015, 54 cents last year, and this year it's 53.5 cents. And the best way to know where that mileage rate is going to be going is to look at your gas prices. If gas prices are going down, your mileage rate is going to go down. If gas prices go up, then your mileage rate will go up. It's important that you keep track of your mileage with some sort of record keeping. That's where most of our small business people have issues, is because they usually don't keep track of their mileage. They'll look at their speedometer at the beginning of the year, they'll look at their speedometer at the end of the year, and then they'll say, oh, I have 10,000 miles and I kind of think that 3,000 miles of those are non-business. The problem is that if they ever got audited from the IRS, that probably wouldn't be enough support to say, hey, this is what my business mileage is. And so they have lots of apps out there that you can use. One is, we've looked, Mileage IQ and TripLog. But as we found, the basic apps, they're great. They keep track of some things, but if you pay a little more money, you'll get a little more bells and whistles. And like most things, I'm sure the more you use the app, the more it'll know where you're going, what you're doing, and it'll be much better to help you keep track of things. So you can either go with the mileage way, or you can do actual expenses, which is like the depreciation for the car, gas, oil, repairs, tires, those kind of things, except you don't get to take all the expenses. You only get to keep a percentage of those business expenses. So it would be percentage based on your mileage. So even if you use the actual rate, you still have to keep track of your mileage. So that's why it's very important that you keep.
So Charlie, just to recap a little bit there, to gain the best tax advantage, really, you would probably have to do something to the effect of tracking both your actual expenses on your car versus your mileage for a year or two to determine where do you get the best bang for your buck from a tax perspective. Is that
kind of true? You almost have to pick your first. You have to kind of pick your lane and stick in it, at least per car. So if you've got one car that's more of a personal use car, then probably mileage is your best bet. But if you've got like utility vans or trucks, we're using it completely for mileage. A lot of times the actual expenses are better because you're going to be using the whole thing. You're going to make a lot more repairs, and that truck's going to get turned over a lot faster than, let's say, your regular old Honda Accord or Toyota Camry that you're just driving back and forth to work.
So basically, Charlie, the bottom line is once you pick a method, you have to stick with that method.
For the most part, yes.
Right. Okay. So let's move ourselves on to number 9.
Number 9.
Countdown. I love this countdown thing. This is awesome. Number 9, unreimbursed business expenses. So Charlie, you want to add anything there on that unreimbursed business expenses activity there, Charlie?
Unreimbursed business expenses are really have become a real big issue for our small business clients this year. Not so much from the IRS, but from the state. A couple of years ago, the state had had someone come in and they paid someone to come in and say, where can they find more revenue? And the area they said was unreimbursed business expenses, because they felt that taxpayers weren't being completely honest with their unreimbursed business expenses and didn't have all of the receipts that they should have. So that's where they've been getting a lot of notices from. And it's important to know that an unreimbursed business expense is an actual expense. It's got to be reasonable. It's got to be necessary. It's got to be well documented. And it's got to be an ordinary expense in the course of business. So it's important that you keep track of these things. And a lot of places reimburse people for. And so what we're finding is that not so much the businesses, but their employees will get reimbursed from their companies, and then will try to report those expenses as additional unreimbursed business expenses. Well, that's a no-no, because what's going to happen is that the state will come in and they will say, hey, what kind of expenses do you have? Show us the receipts. And the big thing they've been asking for now is a letter from your company saying what they do and what they don't reimburse. And so for our small business clients, it's important that they have that policy in place to say what they reimburse, what they don't. And so that way when clients come in and say, hey, I need a letter, they get it.
One of the things from a back office accounting perspective that is always helpful is to make sure that we have it well documented, like Charlie said, and submitting a expense reimbursement form on a regular basis. Just like I do here at the firm, any meal or entertainment or mileage, I have to submit that based on actual expenditures. I see a lot of times that small business owners do not complete that, and there's no receipts or traceable form. Best case scenario would be to have it reimbursed on a monthly basis, or at least accounted for on a monthly basis, but at least quarterly would be a good idea.
Yeah, and then from the shareholders' perspective also, the other thing we've seen a lot more of is shareholders who they get through the year and then they get us to do their return, for their business return, and then they come back for their personal returns, and then they have all these unreimbursed business expenses. If you're a significant owner in a partnership or an S Corp, you shouldn't have unreimbursed business expenses. What you should be doing, like any of your employees, like Lindsay said, you should be submitting those statements every month. And even if you wait to the very end, it's better to submit it and run it through and revise your financials before you give them to the tax return preparers. Because what happens is like when it goes to your partnership, there's no real issues because it looks like any other expenses and they're legit expenses. Even if they are legit expenses and you run them through as an unreimbursed business expense, that's like a red flag to the IRS. Like, hey, come check out these expenses because, there might be something fishy going on. And so it's really important that if you are a small business owner, take the extra half hour, run them through your QuickBooks or send them to us and people like Lindsay who do your back office, get those expenses to run through, because if you don't, it's going to cost you on the back end through notices, having to have someone talk to the state and get all that stuff taken care of. So it's a lot less headache if you get it taken care of ahead of time.
Yeah, just to kind of follow up on that, Charlie, too, I think what we've seen, too, recently when it comes to unreimbursed business expenses is that the Commonwealth of Pennsylvania seems to be all over the unreimbursed business expenses. We don't see it as much on the IRS side as much as we see it at the state side, because obviously the state's looking for money. This is a way that they can easily find some money for somebody that is, not, filing for more unreimbursed business expenses than they should have been filing for. Is that a pretty accurate statement there, Charlie?
Yeah, and then it's a domino that it falls down to locals, because usually what the state does is they'll recheck it, then the local eventually will come back and say, hey, so we see the unreimbursed business expenses too?
So while the impact to a taxpayer is 3.07% at the state side or 1 or 2% at the local side, while the dollar amounts may not be big in regards to the state or the local coming back, it's really the cost is the hassle, because the state and the local are very, I wouldn't say difficult, but they dig into the details pretty good, right, Charlie?
Yeah, they're getting there, especially since they paid to have this study done. So yes, they're very much. And then their next thing is they're looking to is looking at business income too. So mileage on your business returns as well. So it's another
right. So just just as a follow up there, tracking your unreimbursed business expenses appropriately, really, at the end of the day, will save you the hassle of having to deal with the local municipalities or or at the state, but also help you to avoid having other areas of your tax return opened up by those same taxing authorities.
Yep.
All right, Charlie, thank you.
Yep.
All right, down to number 8.
All right, number 8 is the capitalization or expensing of real tangible property. One of the things that we see out there is oftentimes when I'm reviewing general ledger detail is that clients are directly expensing large capital purchases. Large capital purchases are vehicles, franchise costs, loan costs, startup costs, possibly even closing costs, fit outs for new office space or leasehold improvements, large software or computer purchases. And we're seeing these, instead of being a balance sheet item and capitalized and subsequently depreciated, I'm oftentimes seeing these as direct expenses. The IRS, effective with January 1st of 2016, changed their threshold to a $2,500 safe harbor. The safe harbor is a provision or a statute that specifies a certain dollar amount that allows us to have to be, capitalized. So as part of your tax return, I know Charlie and I work a lot together with completing those. We elect safe harbor or de minimis on your behalf and include that as part of your tax return. So from a back office accounting perspective, I am looking through the general ledger detail and pulling out those items and capitalizing them. We would assess a useful life to them. A vehicle, something like that, would be at 5 years, and we would then depreciate that over the course of its useful life. Also, at the end of the year, we will look through your profit and loss detail, looking through auto expenses, looking for large ticket purchases, possibly a deposit on a new vehicle. Oftentimes, I'll look through computer and internet expenses, looking for iPad or system purchases or a new computer. And oftentimes, too, we look through the repairs and maintenance and office supplies accounts, looking for large ticket items.
Yeah, I mean, I don't want people to think that making an election, it's not all that hard. I mean, it's literally like a one-line or two-line statement that we attach to return saying that we're electing to stay on safe harbor and we're bumping up to the next one. And it's important for our small business owners to know that that election is $2,500 per invoice. So, if you're buying a couple things, you get 5 different invoices, and they're each, $600-700 in total. It's more than the $2,500 amount, but each of them separately is $2,500. But in reverse, if let's say you're buying a big ticket item and you pay $2,000 5 times, that's not 5 separate invoices. That's one item. So it's a per item thing when you're looking to expense or invoice. But make sure if you have an item that you pay in installments that you add them together as one before you.
And as a good practice, I would say that it's good to have a capitalization policy on file. I'd be happy to share that with anybody. It doesn't take more than a couple sentences stating who you are, what your business is, and what the purpose of your business, what you do, and then just a simple dollar amount of our capitalization policy is to capitalize any assets more than $2,500.
I think with the new regulations too, with capitalization and repairs, that policy needs to actually be on hand. For a tax perspective. I mean, you made a lot of good points here, Lindsay. I mean, a couple things that stick out to me that I have clients always come back to me and ask me about is, hey, I want to write off my loan cost and my franchise fees, and in some instances you can, in some instances you cannot. I mean, because they would certain, once it's a certain threshold or a certain level. So that's something that you need to keep in mind as you're looking at your capitalization policy, what the amount of that policy is going to be, and then the appropriate documentation and tracking of that. So.
I just assisted a client recently with a large building purchase, and it's great to get a copy of that HUD statement showing the closeout. It's pretty easy to see the loan cost on there, capitalize any of the closing costs, and also see the building purchase as well. So having those source documents really are helpful.
Sounds good, Lindsay. Let's roll to the next one here. Let's talk about number 7. Number 7 on the list. One of my favorites, filing 1099s and W-9s. I got to tell you, every year at this firm in January, it is just mass chaos in January between the 15th and the 31st when it comes to working with our clients to get 1099s back out and then, to get the W-9s in first to do the 1099s. So, we wanted to talk a little bit more about this, the importance of staying on top of this throughout the year.
Thanks, Dave. Yes, 1099s is a crazy season around here, and certainly it's one that clients really should be participating in. 1099s, if you are unaware, are informational returns for subcontractors or services in which you paid in a calendar year, January through December, for service fees in excess of $600. I know several of my clients are reporting on a fiscal year end, such as February the 28th or another. Still, you are required to do 1099s from January through December 31st. I would use your check date as a date in which you would look at that $600 or more over the calendar year. So intangible items, purchasing of customer lists, or web services, rent, professional services like accounting, cleaning, specific handymans, HVAC services, web design, royalties, legal expense, interest income or interest expense paid, hauling, independent contractors, non-employee compensations. It's basically can be individuals who are working for you that are not a W-2 employees. If you have any, all, or only one of those, you do have a 1099 reporting requirement. It is a best practice to get W-9s on file for all of your vendors. I would be checking at minimum on a quarterly basis for any new vendors that you added throughout the quarter. Getting those W-9s on file gives you their complete legal name, their address. Some vendors do have a doing business as, or they might be formulated as a single member LLC with a business name as themselves, the individual, but they go by, Joe's Cleaning Service. And really the 1099 should be reported in their individual name using their social security number. If they are a single member LLC, such as Joe's Cleaning Service, and they have an EIN, we can report it to the EIN. So getting that W-9 on file really is a good, it makes sure that you have done your due diligence.
Lizzie, real quick, let me jump in there real quick with a question for you. So getting the W-9 is of utmost importance. I mean, what is the best practice on your end and to in regards to the W-9? Would you recommend doing it monthly, weekly, quarterly? How would you recommend a small business owner, for instance, that doesn't have a lot of resources to track down or to keep track of their W-9s? What would you recommend?
For the client who doesn't have a lot of resources, I would say at minimum on a quarterly basis to review your record keeping and see what new vendors you've added, and then I would go ahead and request W-9s for the ones. The best business practice there would be to get it before you even release the check to the vendor. So as a requirement to do business with our organization, you should submit a W-9 as part of your vendor vetting process. Get it on file, keep them in an alphabetical order. Even electronically would be good, and make sure you have that on file before you release your first payment to them. You heard me mention earlier that 1099 miscellaneouses are the most common ones we do file. They are sent to vendors for $600 or more. But we also prepare interest statements for interest income, dividends, retirement, such as 1099-Rs, or royalty payments. All of those are for $10 or more. So definitely a decreased reporting, which widens your reporting requirement there. I briefly mentioned that we talked about you can store them electronically or via paper, something that you should be able to access at the end of the year, and it would be really helpful when you prepare them to be able to pull those source documents and prepare your 1099s from that information. A lot of times clients will ask, do I send them to a corporation or an S Corp? If they are set up as an S Corp or a corporation, that is one that we typically do not send a 1099 to. If you're just unsure, like I said, first off, it's an informational return, and it certainly can't hurt to file one. I think we're going to move on to...
Let's go to number 6. Number 6, another one of my favorites, the 2% shareholders benefit reporting. So we see this on a regular basis where we have shareholders of businesses, specifically in the S Corporation world, that are more than 2% shareholders that are receiving either healthcare benefits within their business, or they're receiving some other types of benefits within their business, but they're not being properly reported. We will find this or discover this, and it needs to be reported under W-2. We will find this and discover this, and sometimes it's not identified until after the W-2s are issued, which then become a major problem for amending W-2s and getting them out. So, Charlie or Lindsay, you wanted to talk a little bit more about this with what you've seen?
I'll start here with 2% shareholders. That is any business owner that owns more than 2% of the business. Some of the types of fringe benefits that should be included are personal usage of a vehicle, group term life insurance, policies that are in excess of $50,000, medical insurance benefits if you have medical insurance that you are running through the business. At some point, there may be treatment on your W-2 or on your K-1 reporting your medical benefits, 401k plans, cafeteria plans, dependent care responsibility, and also any domestic or household employees that you may have.
Yeah, I mean, the biggest one that we see with a lot of our small business is health insurance. Because a lot of them, they pay it and they just forget to run it through their W-2. And so, I mean, that's the main one, is if you're getting health insurance through, you need to make sure that you're adding it back, because it's taxable for the federal, but it's not taxable for anything else. And so it's more of a reporting issue, and it just makes everything a lot cleaner. Plus, as we're going to talk about in the next set of slides, we talk about wages. Those type of fringe benefits can help keep that salary up above, so that you're not in the IRS's under the IRS's guns for not reporting enough wages.
For any of those fringe benefits, you should be working with your payroll provider to either set up the necessary codes to add those on as an additional fringe benefit or reporting item. We can always help you with the taxability or how they should be set up for Social Security, Medicare, and FUTA taxes. If you are an S Corp, those items do need to be added to your W-2, like Charlie mentioned. If you are a partnership and you have 2 partners or more in your partnership, those items should be running through your guaranteed payments. We would list those on your K-1, and then we would report them separately as a shareholder deduction on your 1040.
Yeah, it just better allocates the income to the partners that are actually getting the expenses. So, yeah, that's...
Yeah. Okay. All right, we're halfway home, and it's 2:25, so we were right on time, right, Tyler? Tyler's giving us a thumbs up, so I know we're doing okay. So number 5, just as a follow-up to fringe benefits for the 2% shareholders, is wages. Wages that we see for shareholders of organizations and specifically S corporations. So the reason why I want to bring this up as a topic of discussion is that on a number of instances, a number of cases, we see where business owners have either they have an arbitrarily low wage, or even sometimes instances no wage at all, and that's a little bit of a problem. That's a problem from the perspective of the IRS, because the IRS looks at this as a situation of, if the business was operating and you had to hire somebody in that position, you would have to pay a certain wage. So let's say you're a CEO of a business where the typical wage for that business is $150,000, but you're only paying yourself $50,000. see, the IRS looks at that as if, well, that's an arbitrarily low wage. It's for that position. If you had to hire that position, you would pay $150. So your wage should be $150,000. And where the problem lies is that they look at that as a perspective of, well, there's not, because your wage is so low. Well, obviously, you're not with the withholding taxes on that wages are not being taken. Social Security and Medicare taxes are not being taken, and in some instances, we've seen where there's been challenges that have led to audits of the taxpayer, and have also led to the taxpayer having to amend prior year returns.
Well, and Dave, then they go like the whole other way. People who, like you said, they take a really low wage and they take a lot of distributions. And maybe you have $50,000 in wages and $200,000 in distributions. Well, instead of getting the $150, that's probably more on the nose of where you should be. The IRS says, well, no, we're going to disallow all the distributions, and now you got to pay taxes, self-employment taxes on the whole $250,000. So it's better, I know you think, oh, well, I'm going to try to save some taxes. It's better in the long run to make sure that you're paying yourself something that's reasonable. And with the IRS, they have a bunch of factors that they use: your training experience, the duties and responsibilities, time and effort that you devote to the business, the manner of paying bonuses to key people, and then the real important one is what other people are paying, people to do what you're doing.
And in a lot of instances, you can find a lot of that type of data and information through organizations like Robert Half or other organizations that do a number of salary studies. When you do the salary studies, though, excuse me, you should make sure you look at it by region. In metropolitan area, you don't want to just do a national search study because you're going to get varying information. You also don't want to look at, if you live in Harrisburg, look at, well, what is the salary for a position of this type in the Northeast of the United States, because it's going to capture Baltimore and Washington, D.C. and Philadelphia, Pittsburgh. You want to try to get it more regional to the area. A lot of organizations, like I said, like Robert Half, or there's some other organizations out there that can do that for you and kind of get that type of information. But that is one audit defense for you in the event that you would be challenged on wages by the IRS, that you can say, well, I did this study. I have this information right here. That's why I'm paying me the wage I'm paying myself.
I know one of the other things we talk about too with clients is, well, we have a 50% owner and a couple silent partners. Charlie, can you talk to the point too about whether or not we need to pay wages to all individuals, or is it just ones who are materially participating?
It's people who are doing the day-to-day work of the business. So if you are a silent partner and you're really not doing anything, like sometimes we have a lot where it's a husband and a wife, and let's say the wife is doing the business and the husband has a job somewhere else, well, then he probably doesn't need to get a W-2 because he's getting a W-2 from his original job. But the wife would need to be paid for it. So that's important. The other thing I wanted to bring up that we've been talking about is that and this is something that a lot of our small business clients have trouble wrapping their heads around, is the wage is independent of profit. So it doesn't matter how much money you're making in your job. It matters that you're paying yourself. So even if you have a $10,000 loss one year and a $200,000 profit the next year, your salary should stay pretty much the same, because you're doing a job and you're supposed to be an independent employee like anybody else.
Even in that investment year or that startup year, you should be paying yourself a reasonable salary as well.
Yes. And another thing is to think about it is, like, you might say, well, like if I own a restaurant, let's say I own a restaurant and I'm not a cook, I'm not a server, I'm not, a busboy. But you say, well, then I'm not really materially participating in a business. But you're doing the hiring and firing. That's HR work. You're doing the payroll. That's a payroll person. You're doing the back office guy. You're doing all these jobs. Those are jobs. You're materially participating in the business, and you have to pay yourself a wage.
I think it would also be a good practice, too, to have an agreement on file with yourself showing your compensation and your structure that way, like Dave mentioned.
I tend to agree with that, because that's where you can say that, this is what my compensation is as the CEO of the business or whatever, and then you can at least have some documentation behind that says how you got there. Yeah. Makes a lot of sense.
Yep. And as much as S corps are supposed to pay wages, partnerships are not supposed to pay wages. So if you own if you are an owner in a partnership, you should not be getting a W-2 from your business.
Correct.
And we've had several this year that maybe thought they were an S corp and weren't, and found out they were a partnership or just didn't know any better, and they've been paying themselves wages and they get this W-2, and that's a big no-no because all your partnership. If you do want to pay yourself like a wage, you should be running it through guaranteed payments. That way you can assign. I mean, people, and that's another thing people ask, like, what's the difference between assigning guaranteed payments to people or just getting your share of the business income? What guaranteed payments really do is they allow you to assign a certain amount of income to a partner, not beholden to their ownership percentage. So like if Lindsay and I are partners in a business and Lindsay's doing most of the work, but I provide all the financial backing, maybe we'll give Lindsay a salary so that way a guaranteed payment, so that way she's getting more of the income than for the work that she's doing, and I'm not getting half of and then that way she's getting the salary, and that way she pays the self-employment taxes. It helps you that way too. But there's no real difference as far as if you pay yourself 50-50 and your business 50, there's no real difference. But big thing, no W-2s for partnerships.
Absolutely. So you out in the web world right now, no W-2s on a partnership. Yep. There we go. Let's go to number 4. Number 4 on the countdown.
Reconciling
cash. This is Lindsay's and my favorite one. I mean, I like my wages and I like my fringe benefit ones, but this is probably my favorite one because I can't tell you how many businesses don't reconcile cash, which just kind of really blows my mind. Lindsay, what do you?
I would say the same thing. I guess I get continued to be surprised when I get year-end records and they haven't ever looked at their balance sheet. And I'm like, okay, well, did you do your bank rec? What bank rec? I have a bank feed set up, or I'm using QuickBooks Online, and they help me get my transactions into my general ledger automatically. That's great. However, it is extremely important to go back to your source document, which is your bank statement or your loan statement that the bank provides you on a monthly basis, and reconcile to that. I have seen it time and time again where transactions are duplicated. So they'll grab transactions and import from the 1st through the 15th, and then the 15th through the 31st, and that 15th day in the middle there that you picked up twice gets reported twice in the general ledger. All your expenses are duplicated, your transfers are duplicated, cash, deposits that day could be increased. So I guess I'm just continuously surprised that people do not go back to that bank statement that they receive at the end of the month and reconcile to that. A lot of accounting softwares have built-in bank reconciliation functions where you can pretty seamlessly put your bank statement ending date, the bank ending balance for the specific period you are working for, and then simply go down through the bank reconciliation, checking off individual deposits that were made at the bank, and also any checks, transfers, or withdrawals that were made during that period.
Yeah, the thing with reconciling cash, the process of reconciling cash really is not a difficult one, but the consequences of not doing it, because we've run into a number of occasions or a number of situations where the cash balance is higher in your books than it is on the bank statement. And while that's number one a problem from a cash flow perspective, it's also a problem. It's also a problem in your general ledger from the perspective of you're probably paying more tax than you should be because you're not picking up interest expense charges, EFT charges, other small charges that are running through your bank statement that you're not picking up on your ledger, and you're overstated on your income. But the second thing is you have these charges that are running through your statement. You might not they
might not be yours.
They might not be your charges. Yeah, I mean, in today's risk of fraud and hacking, those charges might not be yours. Somebody might have your account information. So there's way more to it than just the procedure of just reconciling your cash note, your cash balances. It's more from a security perspective too. That there's stuff that's not running through my bank statement that shouldn't be running through there.
Yeah, so again, just to be able to reconcile them on a monthly basis, make sure that you're looking at the ending statement. I do save them in a month-end close folder. Make sure you do have those so you can access them at any date and time.
Let's move on to number 3.
Right along the same lines, I would say, reconciling
Lindsay, you're
cash.
stealing my thunder here. But go ahead. Go ahead.
Right along those same lines is the reconciling the credit card statements. Again, we're seeing a lot of accounts and clients where they are not reconciling their credit card statements. A lot of times they get the bank detail piece where the bank will say, oh, you paid your credit card, and either they put it to a credit card account on the balance sheet and never pick up any of the monthly expenses, or they are sticking it into an expense account just called credit card statements. So if you are coding it to your balance sheet, you should also be entering individual transaction charges as they go through. A lot of times I'll see clients entering a complete statement and either putting it in office supplies or running it through an account on the profit and loss statement called credit card expense. And really, we cannot deduct on a tax return, and Charlie, correct me if I'm wrong here, a big account called credit card expense with $100,000 you spent for the year.
No, I would think not, because chances are you're probably going out to eat at some of your favorite places and you're using that credit card. And so
This is
half
true.
of that is not deductible. And who knows what else you're running through there, because when $100,000, there might be some personal expenses that probably shouldn't be in there. So plus, like Dave was saying, if it's important to reconcile your cash for fraud, I can't tell you how many credit cards I've had in the last year and a half because someone's lost my credit card number's been compromised. So I would think looking at your credit card is a must.
It is, and I would say, keeping that statement, again, reconciling it to the ending balance on a monthly basis, making sure you're picking up any large ticket purchases such as equipment or repairs, office expenditures. Charlie mentioned meals, entertainment, making sure those get coded to the proper GL accounts on your profit and loss statement.
Plus, like we were talking about with number 10, with mileage, if you're using the mileage, you can't deduct any of your gas, your oil, all those expenses we had talked about. You might be paying for them with a credit card, but they are not deductible expenses for you on your return because you're taking the standard mileage rate over doing actual expenses, or only a percentage of them would be deductible.
Yeah, exactly. And the thing about the credit card too is, for most small business owners or entrepreneurs, that are out there, they're probably just using that credit card for everything because they're busy people. They're trying to get around. They're trying to get around to things as quickly as possible, and they're just using this credit card. They're just using that credit card mindlessly almost. So being able to reconcile where these charges actually belong to, and to make sure we can pick things up like meals and entertainment expenses or that's really a very important thing, because you don't want to be in a situation where you have an IRS situation and they start to look at the other account, and you find out the other account's all these credit card charges, and then they want to see all the documentation for the credit card charges. It's just not worth the hassle.
Plus, Dave, nothing sets off the IRS's radar like having an other deduction that is like your most expensive expense. Like, if all your expenses are $168,000 and $100,000 of them is a miscellaneous credit card expense, nothing's going to set off their radar like, hey, I wonder what's in that expense. So,
right.
Yeah, that's bad.
Okay. Before we move on, if you do have questions, feel free to submit those questions through the webinar software, and we will address those questions as they come in. And we're looking for questions. I think we have a couple questions, right, Lindsay Young?
We do have one.
Well, let's not get crazy yet on the questions. Or do you want to go to them right now before we... I'm getting a signal from Tyler to go through. Do one. Okay, go ahead. Let's look at this first question.
All right. The first question was, can you please confirm the threshold for capitalization? The de minimis capitalization policy is $2,500.
And that's just safe harbor, Lindsay. But if you're in a construction business where maybe $2,500 is nothing, that policy can be higher. It just has to be within guidelines for the industry that you're in. Some places $2,500 is nothing, but for most of our small businesses, $2,500 is what they'll use. But if you're in construction or retail where you're paying, well, that's a lot of money. That de minimis threshold could be much higher. But that threshold that you're allowed to expense. But de minimis, without having to have any real look through the IRS and say, hey, listen, we'll give you a pass on anything that's under $2,500.
I like it.
Me too.
Hey, we love it, Charlie. Good work, Charlie. All right, let's go to the next one, number 2, charitable contributions.
It's funny, Dave, because charitable contributions, it's really a thing for personal returns for small business people, but a lot of them get confused because they feel like they can't make contributions from their business to organizations so that they get credit, like if you're going to a race and it says sponsored by, by your business instead of by you personally, you can do that because all the contributions that are made through partnerships or S corps or even single member LLCs flow directly to the individual. So it's not like you're going to be losing out on making those charitable contributions. It's important to know that what is acceptable charitable contributions, like cash, stock, or real estate, if you're actually selling the real estate, what a lot of our small business clients find is that they'll say, "Oh, I donated rental space to an organization," which is great. I'm not discouraging you from donating rental space, but if you're not actually giving away something, you're not going to get a deduction for it. And so a lot of them are surprised. Same thing with like cost of goods, like equipment. Like if you're in the carpeting business and you give away carpet, like you put carpet in a church or in a the wine someplace, some other organization. If you give away that carpet, that's great, but you can't run it through your cost of goods sold as an expense and then try to take a deduction for it. You're double dipping.
I would say, Charlie, in a back office accounting perspective for that specific scenario there with the carpet, I have assisted some clients with moving the amount out of cost of goods sold with a journal entry and putting it into charitable contributions. For some business owners, they do like to see that they have made that charitable donation to the organization. I would say in that case, too, it's also important from the recipient to provide you, back the taxpayer, a letter confirming that they have been in receipt of such carpet or a donation of in kind.
Right. Yeah. No. That's important. Is that the donation for the carpet? That's really good. I mean, yes, for sure, move it. But a lot of them, they forget about it and they don't do it. Then the business return's done, it's filed, and then they go, "Oh, we donated this," and at that point, it's too late to count it as an additional charitable contribution. The other thing, and this is more of like individuals, but is donation of service. Like if you're donating your time, unfortunately, there's no guidelines for donating your time. If you donate your time, that's great, but you're not going to get a deduction for it, even if you're a doctor or, even the employees that you have, like if you're supervising. Now, if your employees are working and you pay them, sure, that's something you could transfer to charitable contribution because you did pay them, but you can't take the donation twice. But like you said, you'd have to move it from cost of goods sold. So if you really, really want to show the donation, yes, by all means move it. But if you don't and it's too much work, you can just keep it in cost of goods sold. The other thing that you can donate is mileage. So if you're driving places, you get 14 cents a mile here. So it's not as good, but you get 14 cents a mile if you're driving to an organization, or maybe you're doing like something where you're driving for them, making drop-offs and stuff. Those are donations you can take. Plus, if you're getting anything that you're donating that you're going to be using for the organization, that's a durable donation too. So if you're expending on something and it's like that you're only going to the rule is you're only going to be using it once. It's not something you can say, "Oh, you know what? I'm going to buy this really, really expensive drill." Because they need it, and sure, they probably do need it, but you're going to keep using it over and over again, unless you're going to give them the drill, which chances are you are not.
Charlie, what about in just in regards to when you give a donation and the type of documentation that you would be looking for completing a tax return or any types of information on a corporate return that for a charitable donation?
Well, I mean, if you're giving it away, you should probably get anything over $250. $250 is where you should be getting a letter from them in services. So get it and have to say, thank you for your donation. Make sure they put your name or your business name in it and the amount, and just get it signed. That's really what you need. In fact, they've changed it. The IRS has said now that canceled checks don't count anymore. So if you're writing checks, if you write a big check, you're going to want the letter because the canceled check isn't enough documentation. Now, for us to do your return, it's probably okay just knowing that, you may have to go back to the organization and get the letter. But if you can get the letters ahead of time, that's probably the best practice.
Okay.
I would say it's also just a good practice in general to keep, your tax documents in a little shoebox, a basket in the corner of your bedroom, office, backseat of your car. It doesn't matter. We get all sorts of types of files and client records and documentation. And as you are making those donations, like the letters that come on a regular basis, I would go ahead and toss them in that shoebox or in that basket and make sure that you have a specialized area and a place where all those documents can accumulate as they are received.
Yep, and then just hold on to them for 7 years.
That's right.
So you're gonna need 7.
All right.
Dave, can I interrupt really fast? We got a question.
Gosh, go ahead. Jump in.
We got a question. There was a question from one of our viewers, or listeners, I guess I should say. Is Charlie still the hardest working employee at McConley and Asbury?
Well, let me address that. Let me be the first one to address that. And the answer to that is probably yes. Charlie, you can see just from today the hustle that he just showed. That's why we call him Charlie Hustle. The hustle that he's showing today in this webinar. So I would say, yeah, probably he's the hardest working employee in the firm. I'm going to stick by that. All right. Let's go to number 1. Like-kind exchanges. The reason why we put like-kind exchanges in here is because we've seen on a number of occasions here recently where there is a situation where they're taking where a business owner is selling property and then or exchanging it for another piece of property and not understanding the complete consequences or how a like-kind exchange works in regards to the time period and when you got to exchange it, how the exchange has to work, the type of documentation. Charlie, why don't you add a little bit more color to that, Charlie? Hardest working employee in the firm.
Thank you, Dave. Like-kind exchanges are actually, when Dave says the consequence, a lot of times it's because they're not taking advantage of like-kind exchanges. Like-kind exchanges is one of the give-me's that the IRS is giving you. So if you exchange like-kind property, and the most common thing that we see with our small business are cars. So if you've got a car, or a business van, not a car, let's just use business vans because it's easier. You have a work van that you've used for a couple years, you've depreciated it, and then you trade it in and you get cash back. Well, that could be a gain that you have to report on your tax return. But then you take that cash that you get and you trade in for a new van. So there's no real cash to pay the taxes. And so the IRS allows you to say, well, since you didn't actually get any cash for this gain, we're going to allow you to defer it to when you sell the product at the end. So if you sell that car again and you take the cash, then that's a gain you have to report. But it's really important that cash, like Jerry Maguire says, show me the money. You want to, cash is the most important thing. So if you take control of that cash, that's when you spoil the like-kind exchange is what they say. And so with cars, it's not a real big deal because we're not talking about a lot of money. But what we've seen with a lot of our clients is that if they own buildings, rental property buildings, if you exchange building for building, or like your business, if you buy like a new facility and you want to sell your old facility, there can be some real tax savings there if you do certain things. And the main one is that you have to get an independent agent to handle the cash. So you go find, there's lots of people, lawyers, some real estate agents will be good at doing these. They're called like-kind exchanges or 1031 exchanges. Some people call them 1031 exchanges. They'll take the cash for you. They'll hold on to it till you buy the new building. There are a couple things that you want to make sure that you do, that you have a building identified within 45 days of when you actually buy. So when you sell the property, you have to have within 45 days of the time you sell that to identify the next building. Now, you don't have to buy it within 45 days, but you have to have the place you're going to buy identified within 45 days. Then you have up to 6 months to do that. So that can give you some really good savings. We just did one for a client. It was like $100,000 that they saved in income. So at their tax rate, it was, $40,000 in taxes they saved because they took the time, they hired someone, they did it, and they did it right. So that's big savings for people.
And Charlie, you're right about sometimes people don't understand the concept of like-kind exchanges because just recently we had a client that bought a car or had a car, sold it. They had a car in their business, sold the car in the business, thought that they had gain on the car, and then went and bought a new car. They didn't realize that, the vehicle is being used for 100% business purposes. They didn't realize that, really, quite honestly, at the end of the day, you could do like-kind exchange on that. So that was the year they were almost a situation where they were going to pay tax on on gain that they didn't have to pay tax on right now. That they obviously would have to pay it over time at some point in time if they didn't do another like-kind exchange, but for right now they could defer it.
Right. And I mean, the thing is it's important. It's one of the things that it's really important to do it ahead of time. So before you actually decide to sell that car, if you're going to sell something and you think it's worth a lot and you want to buy something else, it's a good idea to always talk to a tax preparer or your tax preparer to say, hey, what are my options here? Because, if you've already, like I said, if you've already taken the cash, you've spoiled it and it's game over. So that's the big thing, is so that you don't actually have the cash. Because in the IRS's opinion, if you have that cash and you're holding on to it for 6 months, you could take that cash and put it in even a simple interest account where you might get a 1099 that Lindsay's going to prepare for you down the road
Right.
for interest income. That's money you made on that money until you've actually used it. And so that will spoil it.
Absolutely. All right. We have completed our top 10. Excuse me. And I have to apologize to everybody in webinar land. My voice is awful today, but it's allergy season. So we do have some questions that have come in.
One of the questions that came in is, if we are talking about wages and what is appropriate for a business owner to take in a wage, how do you determine this? I think you highlighted a little bit before, talking about Robert Half. Can you just elaborate on that a little bit?
Yeah, sure, Lindsay. So, as I was saying before, there is the ability to gather some data from organizations out there. Robert Half always sticks in my head because I know that they do national surveys and national studies of salary information. But that would be a starting point in my mind that you would want to go to. Other areas that you could actually go to gather some data on would be your local chambers or local workforce development organizations, because they typically gather that data as well regionally within the states like Pennsylvania or Maryland or Delaware. You could gather that data from them as well. But it would be it's a good option to use that information to help you set or determine what you think an appropriate wage would be for your business.
Thanks, Dave. There's another question that just popped up here. What would be the best setup for me to have when you are looking at my mileage when I submit my tax documents? Charlie, I think this one's for you.
Yeah, I mean, what you really want, unless you want to go old school and have the little notebook that you keep in your drawer and handwrite. Which we like. I will gladly take that. What you should try to do is a lot of these, like these apps that we talked about earlier, the Mileage IQ and the Trip Log, they will print out reports that will have, the date, the trip where you were going, and the mileage. And that's the best. But if you can't do that, just a day total, like, your speedometer, that's probably your best bet. But something that has like the date, the amount of miles, and what you were doing, that's probably our best bet.
Thanks, Charlie. I think there's one more question here and maybe another straggler. The next question up here says, let's say I've never reconciled cash. Is it too late to start now? No, definitely not. I would suggest starting and completing the reconciliation as close to as you can back to January 31st, and then I would start reconciling on a monthly basis there afterwards. I would make sure that when you are reconciling that January statement, that any items that do not clear until February, you would leave them open and available to complete as part of your February statement. One of the things we do see out there as a potential issue is a one-time adjustment that may be made or necessary in order to bring your bank balance into your general ledger balance. This one-time, benefit, whether you have to recognize income or expense, would need to be posted to get it to reconcile. But understand too that in the past you would have either recognized the benefit in a previous year or paid the tax in a previous year.
Lindsay, just one question for you there. Would it be appropriate? Would it be a better idea to go back to December 31 to reconcile that balance? Because that would become your beginning balance, right, at January 1st.
It would. Most times I reconcile whatever the first month is available in the year, so I have a good clean cutoff, and I can look and see what deposits. You could pick December 31st, and then you can see what deposits I would have January's bank statement available to make sure any deposits that clear or checks that were written in December that clear in January, to make sure they are selected or unselected depending on how the bank reconciliation needs to flow.
Okay, good. Any other questions there, Lindsay, coming through?
I think that was our last one. I don't see any others on the screen here.
Okay.
Thank you once again for joining us for this presentation produced by McConley & Asbury. We hope you join us for our upcoming events. You can stay up to date with news and learn more about our upcoming presentations by visiting us at www.macpas.com. Thanks again, and have a great day.